Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
All right, so let's start. First, to start off, I have asked a few of you for the feedback on the two guest lectures. So these are some of them. Right, so a lot of you said that the second guest lecture in particular was quite technical, and there was some concerns about that it's not recorded. And I agree that it has been quite technical, right? And the not recorded part, well, so for Dr. Tan, he comes from the biggest sovereign wealth fund in Singapore, and they have a lot of regulations. So before he came here, the legal office for GIC actually sat him down and gave him a 1-hour session as to what he could say and he could not say if he was asked specific questions. And they also gave him pages of standard official responses to questions. So they take it very seriously, right? Because for GIC, they're moving a lot of capital across international markets. So whatever he says can be seen as positions taken by the GIC. So from a professional perspective, even though we may feel a bit disappointed that it's not recorded for such a fantastic session, but we don't want him to lose his job, hopefully, right? And he can also come back in the future. And that would be what you go out if you are representing your companies and what you would want to do, right? If you're speaking, you have to be concerned that other people don't take your words just as your own words. They take it as official representation of the firm itself, right? So the second part, right? So although the content was definitely very technical, and I am sure that for a lot of you, it just went over like that, right? Because for me, at my stage, back in the master degree, I probably would feel exactly the same. He's been trained in a doctorate study as well as postdoctoral studies. He has years of experience in the area. So whatever that he was able to tell you was accumulation of all those years of experience, right? So we would not expect ourselves to be able to reach his stage. But what I really appreciated is that he was able to come here and give the top-down approach, like to give it to us. That's really remarkable. The content that he was able to show to us, you probably will have to pay a lot of money for in real life, right? So that is the kind of opportunity that we actually had with Dr. Tan's presentation, which was very different from David Nolan's approach because he's a sales person. He's on the sales side, right? So his is more overall general, right? So this was really good because both of these guest lectures gave two perspectives of what you can expect in this career, right? So some other comments was that, you know, what I would want you to focus on is really on what you can expect if you aspire to have a career in this area, right? So you need to understand what kind of framework it is that if you're working in this area that is expected of you. Understand that perhaps you have something to aspire towards if you want to achieve a successful career in foreign exchange markets. In particular, if you're just trading, that's only at the entry level. To do what he does is the top level that you want to aspire for, right? So that was really that really came through in the comments. And also, what I want you to see from this, rather than that it has been very technical, is that, you know, if you are going towards the area, what kind of things that you would want to take notice of when you're studying. So this course is a starting point towards that area, right? So if you want to do really well in the career or go towards that aspect of your career, then this is the groundwork that you have to do. But if that is not something that you want to do, that is fine. This course is still useful, and I'm going to be trying to help you with my very best so that you can pass the course if that's all you want, right? So I'm trying to tailor my course to you for all of your needs as well. And so, so don't feel bad if you did not understand every single bit. As I said, if I was back in my first year master's degree as all of you, I would be probably completely lost, right? So I totally feel for you. I did not expect that he would give so much technical detail, because he didn't share the slides with me, and he didn't share his talk with me. But I was completely astounded by the level of detail that he was willing to give in this guest lecture. So that was really gold. But don't feel distressed, right? So what you're going to be tested on eventually, if I put on a question in the final exam, is more about the general macro drivers that we have already talked about and that he has talked about in the guest lecture. And as I said, if I'm going to put it on the final exam, I'm going to go over in the review session, right? I'm going to go over in the review session whether I put it on the final exam or not, okay? But I always stand by my promise that you should not be surprised in the final exam. Everything that you are tested on in the final exam should be already talked about either in class or you have done it in the problem set, right? So please do not worry about that. And take the guest lecture for the kind of goal that it is. All right? Any questions about this? Good. So before then, we talked about value at risk. So various ways that we can measure foreign exchange rate risk. We stopped in week 7 at talking about value at risk. where we talked about how to measure transaction risk, right? So value at risk is a measure that we are able to find that with 95% or 97% or whatever percentage of confidence that the maximum loss the firm is going to face from its foreign exchange exposures is not going to be beyond a certain amount of money, right? Coming back, sort of? Okay, all right. So for the rest of this class, we are going to finish talking about value at risk by applying it to a portfolio of different foreign exchange rate exposures, because in the last part, we only talked about exposure to one type of currency. So in this part, we're going to talk about exposure to a portfolio of multiple different foreign currency. And then we're going to talk about how to measure economic exposure through sensitivity analysis and regression analysis. And then in the final part, we're going to be talking about foreign exchange rate reduction. Once we know what the risks are, and we know how much risk that we're exposed to, we can do something about it. So that is the agenda for the next hour. Let's go forward. Okay, so this is the case where we are going to be looking at applying the value at risk to a currency portfolio. Let's start into it with an example. DSQ Co., a US firm, expects to receive payments denominated in the Indonesian rupiah and Thai baht, right? So we have two currencies here in 1 month. That is the time horizon. Based on today's spot rates, the US dollar value of the funds to be received is estimated to be 600,000 for the rupiah and 400,000 for the Thai baht. DSQ estimates a change of 0% for both currencies over the next month, and a standard deviation of monthly percentages changes to be 7% for the rupiah, so there is a spelling mistake here, and 8% for the Thai baht, and a correlation coefficient of 0.5 between these two currencies. So the likelihood that they co-move together somewhat. Assuming that the monthly percentage changes of each currency are normally distributed, what is the maximum expected 1 month loss due to a potential decline in the value of the portfolio of the rupiah and baht based on a 95% confidence interval, right? So whenever you look at a question into value at risk, the first things that you identify is how many currencies are we talking about here? Do we have just one, or do we have two, or multiple? If we have just one, then we go back to the example that we have shown you in week 7. But if we're talking about currency portfolio, then we have to identify a few more things. So we have to identify the time horizon, right? So it's 1 month. And then we identify the potential expected change in the currencies, as well as the standard deviations. Those are all inputs into the formula. And then we want to know what is the confidence interval, so then you can get the corresponding Z-scores to calculate the value at risk. And we always remember that these are normally distributed. That is the major assumption in using value at risk calculation. Only if the changes are assumed to be normally distributed would the value at risk calculation be correct, right? Because only the first two moments matter in a normal distribution, the mean and the standard deviation. All right, so now the extra complication here relative to the previous example is that we have a currency portfolio, so we have to start caring about covariance and correlation. Okay, so let's get into it. So we have two currencies here, and so in total, what we find is that it has $1 million exposure to the Thai baht and the rupiah altogether. And so the rupiah constitutes about 60%, while the Thai baht constitutes about 40% of the portfolio. Now, why are we doing that? This gets into basic statistics that you should all be comfortable with, right? That we have done in either your 7006 class or your 1001 class in undergrad, if that's what you have taken. So this is where we start calculating the expected mean change. Okay, so we are told that a percentage change of 0% for both currencies over the next month. So that makes our calculation for the mean expected change to be simple. So we have 60% multiplied by 0% plus 40% multiplied by 0%. So the overall expected change in the currency portfolio is going to be 0%, right? If it is not 0, then we're going to just change the 0% here. Very simple. Next, because we assume the portfolio changes to move with the normal distribution, we have to calculate the standard deviation. The standard deviation for a portfolio has to account for the covariance between the two currencies. So this is the standard formula, right? So this is the formula that you would find in your first year statistics class. How to calculate the standard deviation or the volatility of two random variables. So that is the formula. And you would remember that formula, right? Seriously? Do we need it on a formula sheet? How many actually want it? Well, I'm not seeing everybody's hands. Okay, so I'm calling, do you want it on the formula sheet by the show of hands? If not, then this doesn't look like a majority. Okay, fine. Okay, so you will be provided with this formula. All right, so democracy here. Okay, so basically then you're going to substitute in the weights of the two currencies and then their expected, their standard deviations, right? And then you account for the covariation between the two currencies. And then finally you get that for the entire portfolio, the standard deviation is 6.4280634. Okay, good. Now we have the standard deviation and the mean ready. Now we are back to the first example of just one currency, right? So then the application of the formula is straightforward here. The maximum 1 month loss of the currency portfolio is calculated by the same method as that we have had before, and we are going to have a loss, expected loss of 10.6% at 95% confidence interval, right? So that's what you expect to lose with, at most, with 95 confidence interval in 1 month. What you should realize here is the following. If you looked at either currencies individually, the maximum one-day loss would be negative 11.55%, or if you are looking at just the baht, negative 13.2%. What do you notice here relative to this number? Having a portfolio of currencies reduces the risk, right? So that's what you see exactly. the currency portfolio here has sort of a lower risk. Why do we have that? Diversification, right? So we have not perfect correlation between the two currencies, and with that, we have diversification, which is the number one rule when we're trying to construct portfolios. We're looking for currencies that don't correlate with each other a lot, so we can get diversification going on. And this is what's happening, right? So here we have the diversification effect. The lower the correlation between the two currency movements, the greater the diversification benefits. When do you get the biggest amount of diversification? Perfectly negative correlation. So if one currency goes up, the other currency would go down by exactly the same amount, right? So that's when you get the maximum amount of diversification. So when you're going into these kind of questions, and if you're seeing that you don't have a perfectly correlated currency pair, then the first check in your mind when you're looking at your solution is to see whether or not this is relatively low, right? If you have a question that asks you to calculate the individual currencies and their maximum loss, and your portfolio loss ends up to be higher than your individual currency loss, then you need to go back and check your answers, right? Because we have diversification going on here. Very, very good. So we do have a lot of currencies that co-move together to different degrees. So this is a calculation of the correlation among movements in daily exchange rates calculated from 2009 data all the way until 2018 data. The data that you can get can be obtained from the Fed. They have a lot of really good details and data. So looking at this, what do you notice about the co-movements among different economies? So if you were to construct a portfolio as a firm manager and you want to maximize the level of diversification that you want to have in your currency portfolio, which pair of currencies would you change? Would you have? Right, right? So this is the only one that stands out immediately because it has a negative correlation. And as we said, if they move opposite to each other, there's a greater potential for diversification. So if you are a manager and you can pick amongst all of the currencies that you can choose, then you would choose probably the Japanese yen and the Mexican peso, right? Which currency pair would you not want to choose if diversification was your goal? Australian dollars and New Zealand dollars, right? So there's an 81% correlation between the two. So if diversification was your goal, you probably don't want to have the two moving together. And why is that the case? Now coming into economic fundamentals. Why do we see the Australian dollar and the New Zealand dollars moving so closely together? Right? So New Zealand is very dependent on trading with Australia, right? So we would expect that New Zealand dollar to correlate very highly with the Australian dollar. The same thing between, say, Canadian dollar and the US dollar. But I would say that the Canadian dollar is a bit more diversified than the New Zealand dollar because Canada also has a lot more trade with other countries as well. So this is where you can go by your economic instinct. If you know that two economies are closely tied together with trade and economic independence, interdependence in this case, right, then we would expect their currencies to fluctuate highly together. Yes? Yes? In the same direction, definitely. Very, very good. Okay. Right, so this is a chart that summarizes how you can expect expected cash flow fluctuation to move together in some way or the other. And I'm not going to go too much over this because it's very clear. Please read it yourself. Okay, the next part, how do we actually estimate value at risk with a spreadsheet in real life? Right, so you can actually do this with Excel. So I go through the steps here. So first of all, you're going to get a series of the exchange rates for all the relevant dates that you care to have for every currency of concern. And so you can get this from the Fed or the central banks. A lot of the central banks would publish these kind of series. The Fed contains a lot of exchange rates with respect to the US dollar and the Australian dollar. The RBA, Reserve Bank of Australia, contains a lot of exchange rates against the Australian dollars and so on. So put each of these exchange rates in its own column. Then we can compute the percentage changes for every period from one date to the next. So if you care about daily volatilities and changes, then we have daily changes, monthly or quarterly, and so on. Okay, and then we export the number into a different column, estimate the standard deviation of the column of percentage changes for each exchange rate, which is gotten from step 2. Then in a separate column, compute the periodic percentage changes in the portfolio value by applying weights to the individual currency returns, right? So that's what we did at the beginning of the portfolio example. We computed the weights of Indonesian rupiah, and the Thai baht, each to be 60% and 40%. That is the weight that we're talking about. And then we can compute the standard deviation of the column of percentage changes in the portfolio value, and then we can plug the standard deviation calculated in the previous step into the VAR formula, right? So if you see this in an actual calculation, this is what you would do. That's the exchange rate series of the euro and New Zealand dollar against the US dollar. So that's raw data. So this part is raw data. And then you calculate the percentage changes, and then you calculate it within the weighted portfolio with the weights, and finally you can find the standard deviation for the portfolio. I would suggest that you can try this out for yourself. Because then it's a very simple way to do that. So what are some of the limitations that you can think about with the use of value at risk to measure transaction exposure? Based on everything that we have said, what are some of the potential limitations that you can see? Limitations as in that it could be potentially not correct, not as accurate as you want it to be. Any thoughts? Or you're just a little shy for now? Right, so with the value at risk calculation, our basic assumption is that all of the changes are normally distributed, right? So what if the changes are not normally distributed? Then our calculation is going to be off because the fundamental assumption doesn't work. And in practice, the changes in currencies tend to be not normally distributed. They tend to be actually skewed, especially for emerging market currencies, right? So in this case, the basic assumption that the exchange rate movements distributes according to a normal distribution can be a really big potential for inaccurate numbers. So in this case, then we might have to have more complicated models to accommodate for the differences in distributions. And as I said, this problem becomes more prominent for emerging market currencies. So if you are trying to estimate the value at risk for emerging market currencies, then this becomes more of a concern. And so you might have to have more complicated models to account for the skewness and kurtosis. Right? So that is one point that I really want to emphasize in the use of these formula in the financial market. What happened in the financial crisis with the credit default obligations and swaps, with all of that, a lot of these financial engineered products are based on the assumption of normally distributed changes and prices. But that is often not the case in real life. So when scholars develop them in an academic setting, they cannot dictate how you use it in real life, right? It doesn't stop you from using this formula on an emerging markets currency without any adjustment. But then the result that you give could be potentially off. So from your perspective, that is bad because your boss can look to you and say, hey, you came up with the wrong figure, you're fired, right? And often the case is the scapegoat is on the academic who developed it. In the financial crisis, there was this really well-known Canadian scholar from the University of Waterloo that developed a pricing formula for one of these financial instruments that was used by a lot of people in the subprime mortgage crisis, well, leading up to the subprime mortgage crisis. And he got the flak for it. He was fired by his bank. He was working in the industry at that time. But the root problem of the matter is everybody was using it, ignoring the basic assumption that they are thinking that it's normally distributed. So do you think that was fair? I'm not sure if you think that was fair, but I thought it was totally unfair. So I think that it is for you to go out there using all of this. Yes, you can use these formula or shortcuts, but make sure that you're going to hedge yourself by stating the assumptions clearly in all of your calculations, right? And then if your boss comes to you and asks, how come you gave this wrong number? At least you can fall back on, hey, I said this is based on assumption of normally distributed changes, right? And also have a bit more thoughts about what you're using. That's important. Okay. The second point in using the VAR is that it assumes that the volatility or standard deviation is stable over time. But this is clearly not the case because markets are always changing. So these are random variables and they are changing all the time. So again, if there are sudden shocks or the exchange rate movements are less volatile or more volatile than in the past, then the estimated number is going to be off. It could be underestimated or overestimated. So these are two of the most important things that you should take in mind when you're going out to produce numbers, right? So be aware of the assumptions. Providing the context is very important. But other than that, this is a very simple and straightforward way of calculating value at risk, and that is why a lot of companies use it. Right? So if you look at the 2018 10K form, which every public company in the US has to file to the SEC, then you can see that they analyze their transaction exposure in exactly the same ways. So in general, they identified Apple is a net receiver of currencies. And if there is a strengthening of the US dollar, it will negatively affect the company's net sales and gross margins expressed in US dollars, right? And so there's also a significant level of volatility in foreign exchange rates with respect to the US dollar that Apple has identified. Therefore, in order to be able to forecast and assess the level of transaction exposure that Apple has, they're going to use the value at risk method. And in real life, to account for the differences in assumption of normal distribution, they will often use things such as Monte Carlo simulation in addition to more complicated models, right? So I can't go over that because I cannot assume that level of statistics in you, but if you are interested, it is available, right? And look at Apple in doing its hedging, right? So the VAR model is not intended to represent an actual loss, but it's used as risk estimation and management tool, right? They state their assumptions. Based on the results of the model, the company estimates with 95% confidence a maximum one-day loss in fair value of this much amount, right? So that's where they use for comparison. Because the company uses foreign currency instruments for hedging purposes, the losses in fair value incurred on those instruments are generally offset by increases in the fair value of the underlying exposure. So this is the part that we're going to be talking about later in this hour. Okay, so that was transaction exposure. What do we do about economic exposure? So economic exposure, if we recall from the definition, is the extent to which the value of a firm would be affected by unanticipated changes in exchange rates. And you can have economic exposure whether or not you have actual trading with a foreign company or country, right? We had the Barrington Steel example. So what do we do here? We basically had the second alternative definition for economic exposure, which says it is the sensitivity of a firm's future cash flows to unanticipated changes in exchange rates, right? And it is a subset of, transaction exposure is a subset of its economic exposure. So how do we measure it? Basically, there are two methods: sensitivity analysis and regression analysis. So how do we go about that? Let's take a look at an example. Sensitivity analysis. Basically, sensitivity analysis look at separately how sales and expense categories are affected by changes in exchange rates. And the important part is to develop scenarios. So it's very related to scenario analysis. So let's take an example. Here we use our favorite company again, DSQ, a US firm which estimates the sales and expenses for its US and Canadian business segments as below, in millions of currency units, right? So here in this statement, we see each of the sales, costs, operating expenses, and cash flow for the US business and the Canadian segment in US dollar as well as Canadian dollar. So what do you notice about DSQ's businesses and cash flows? what can you summarize about DSQ's sales and expenses and cash flows in terms of the different currency exposures? First of all, is DSQ likely to be affected by foreign exchange rate exposure or changes? Let's do it row by row. So in terms of sales, is DSQ affected a lot by the US dollar, Canadian dollar fluctuation? Not really, right? Because sales in terms of Canadian dollars is only about 4 million, whereas the total amount in the US business is far bigger. So in terms of the sales fluctuation in foreign exchange rates is likely not to have a big impact. What about the cost of materials? Yes, right? This is where the bite come in, because there is a lot of expenses in terms of the Canadian dollar. Okay? What about the interest expenses? Because in operating expenses, there's no Canadian dollar denominated operating expenses. Everything is operated within the US headquarters, bless you. So interest rate expenses, is it going to likely be a problem? Sort of, potentially, right? Because there's about 10 million Canadian dollar exposure to the interest rate expenses, where there's only about 3 million. So overall, the business earns its income in terms of the US dollar, and most of its expenses are in the Canadian dollar. So what would be bad for DSQ? A strengthening of the US dollar or a weakening of the US dollar? What would be bad for DSQ in this case? When you have more expense exposure to a different currency, but all of the sales are in your own domestic currency. Do you care about the strengthening of your currency or the weakening of your currency? The weakening, right? Because if your currency weakens, then more of the foreign expenses are going to be translated into your domestic company's domestic currency expense, right? So let's take a look at the scenario. So in the first scenario, we have 1 Canadian dollar giving us 75 cents US dollar. And in the second scenario, we have 1 Canadian dollar giving us 80 cents. And in the last scenario, we see the Canadian dollar strengthening and the US dollar weakening. So let's take a look at that implication. So what are the implications for sales? Well, in all three scenarios, yes. In the first case, right, your total sales in terms of US dollars is 323. In the second scenario, when the US dollar weakens a little bit, then you have more sales translated, but that's only about 0.2 million. So that's not significant. And in the last scenario, you have yet a little bit more sales in terms of US dollars. The bite comes in the cost of materials and operating expenses. Okay, so in the first case, you have the operating expenses in terms of the US dollar, as 200, 210, and 220, right? So your expense went up by 10 million and 10 million, respectively. 10 million and 20 million. So if the US dollar weakened as we expected, the expenses increased significantly, right? So what about the last part? The interest expenses. Again, as Canadian dollar strengthens and the US dollar weakens, the interest expense in terms of the US dollar become bigger and bigger. Far outweighs the increase in the sales revenue, right? So if more of your sales is in a foreign currency, then the strengthening of your currency is bad. But if more of your expenses are in a foreign currency, then the weakening of your currency is bad, right? All right. So the cash flow in the US dollar before taxes is going to be the highest in the case where the Canadian dollar is relatively weak and the US dollar is relatively strong, and it decreases the cash flow as the Canadian dollar strengthens and the US dollar weakens. So if you are a firm and you have more in foreign costs than foreign revenue, then that's going to unfavorably be affected. You have a stronger foreign currency, which summarizes what we just said. And so that's why we want to do this scenario analysis, where we can see that if we have these different scenarios, what can we expect in terms of our cash flow in the domestic currency? So this is one method, sensitivity analysis. The other method of measuring economic exposure is through regression analysis that you do by collecting the data and running regression models. So in this case, we're going to test the following model. We're going to try to see the percentage change in inflation-adjusted cash flows measured in the home currency of the firm over a period T, which is the dependent variable in the regression model, right? And our variable of interest is E sub T, which is the percentage change in the direct exchange rate of the currency over period T, and that is the independent variable, or the variable of interest. And after feeding this model through a statistical software, what we're going to be interested in is beta, the slope coefficient, bless you. The slope coefficient of the sensitivity of the firm's cash flow to changes in the exchange rate, right? That is the definition for economic risk. Okay, so this is the variable that we're interested in. How do we interpret it? If we see a beta coefficient that's both positive and statistically significant, then that tells us an increase in the foreign currency's value has a favorable effect on the firm's cash flows, denominated in home currency. And if there is a negative and statistically significant coefficient beta, then we see the inverse of what we saw here, right? So that is the interpretation that's really important. It's easy to feed through the regression model, but what do we do about the interpretation? And if the firm anticipates no major changes in its operating structure, that means the operating structure that we saw in the DSQ's case, that more sales is generated in the US and more expenses is generated in Canada, then we can expect this exposure to continue for some time in the future. And also assuming that volatility or exchange rate changes are not going to change very much over time, right? Exactly the same assumptions as before. And this model can be revised to include additional currencies or an index of different currencies that the firm has exposure to. And you can test for also, instead of the percentage changes in cash flow, see how their stock prices are affected with respect to changes in the foreign exchange rate. Because at the end of the day, a lot of the firms, especially public firms, care about changes in their stock prices. Because at the end of the day, managers, they get their bonuses and compensation based on the stock price of the company, right? So managers often care about whether these exposures are going to impact on their stock price. All right, so that concludes our discussion of how to identify risks. The different exposure that we have talked about, sensitivity analysis, regression analysis, value at risk, as well as basic accounting methods, looking at different scenarios. Now we can do something about risk reduction. But before we do that, why don't we take a 5-minute break? Back here promptly at 4:01, please. All right, so let's start again. On my break, I had a very interesting discussion with our class members on how you don't see the law of one price often hold in real life. For example, the cost of pancakes, right? The cost of a pancake in China is probably about how much? 10 RMB? One. So it's about $2 Australian dollars. But if you buy them here in the bus interchange bubble tea shop, how much is it? $8. $10, right? That's huge price difference. So law of one price doesn't hold here. Remembering our assumptions of the law of one price, what do you think went wrong here? Why doesn't the law of one price hold for the pancakes in China versus here? Okay, right? You can't, first of all, it's not a transferable good. You cannot transport it. You cannot just buy 100 pancakes in China, go on the plane, and try to come into Australia. First of all, the quality will be really, really bad once you do it. And second of all, you'll be asked to go into customs and have a talk to, right? So this price difference cannot be arbitraged away. So what is the second biggest point that you would see the price difference and the law of one price doesn't hold? Between the price of a pancake in China versus the price of a pancake in Australia, in Canberra especially. Right, the material that you use and the process is probably the same. Hopefully it's the same, right? So you would argue that the quality may be different, so it's not comparable, it's not a substitutable good. Yes, definitely. And one other really big factor, transportation cost. We're talking about cost, definitely. What's the biggest difference between cost in China and cost in Australia? Labor cost, right? So for making a pancake, how long does it take to make a pancake? It depends. Say 10 minutes, okay? 10 minutes is a benchmark. Okay, maybe not more, okay. But anyways, just say 10 minutes here. So 10 minutes in Australia's wage, that's probably how much? What's the minimum wage in Australia? $19, right? So we multiply $19 per hour by 10 minutes, and that's your labor cost. What is the minimum wage in China? Zero. Right? So immediately we see where we can have a fallout of the law of one price, right? Just because of the labor of input. Right, cost of input in terms of the materials and the labor and so on. So it's always nice to think that we have a benchmark, but sometimes in real life, because of all the different frictions and transaction costs, they don't necessarily hold. However, that doesn't mean that what we have learned is totally useless. We have learned a good benchmark. And we know what kind of friction exists can cause these things to happen, and we can work towards reducing these frictions. Right? First of all, we identify what a problem is, and then we can work on reducing it, just as what we are doing in this hour, in the past hour and right now. Right? We first need to know what a problem is. Okay? Is the minimum wage in China really zero? I don't know. So, no. That's definitely an exaggeration. No, we do not exploit people. I'm not going to stand here representing ANU or the Chinese people and say that they're doing that, right? But I think it's just an exaggeration to say that the labor cost is very low, right? And also for self-employed employment, so you're not going to pay yourself a wage. Yeah. All right. So, okay, very good. So we identified what the problem or exposure is. Now we can start on trying to hedge it or to reduce the risk. And that is what we call hedging. There are two ways of hedging. Can you already think of some without me showing what it is to you? What do we usually do when we're hedging? Derivatives, right? That is a really, really useful way of doing hedging. And that is what we usually call financial contracts. So this is a financial hedge. And the other method of hedging is through operational approaches, which is what we call a natural hedge, without the dependence on financial products. Okay, so we are off. So how do we hedge with financial contracts? Then we list all of the products that we know from derivatives, and also what we have learned from financial markets. So we can use forward hedge, option hedge, money market hedge, cross-hedging with minor currency exposure, and hedging with operational techniques. Then we look at how we can change our cost and our expense and our sales structure in order to minimize our exposure to foreign currencies. But we're going to look at examples of that. All right? Start with an example. Summarize everything into an example. Boeing exported an aircraft to British Airways and billed £10 million payable in 1 year. At the time, the US interest rate is 2.5% per annum, and the UK interest rate is 0.75% per annum. The spot exchange rate is $1.30 per British pound. And we also have the forward exchange rate at $1.32 with 1 year maturity. Okay, so everything is here. However, this must be like just term payment, because I actually looked online. The cheapest Boeing right now is the 737 MAX, which costs roughly about $100 million US. So this is not for one aircraft for sure. All right? Okay, so what do we have with forward hedge? Let's do an example of that. So with a forward hedge, with that example that we just saw, that basically means that if you receive foreign currency in the future, that means it's accounts receivable tomorrow, you're going to agree to sell the foreign currency today by taking a short position in a forward contract. If, on the other hand, you have exposure in terms of your accounts payable in the future, then what you're going to do is that you are going to buy the foreign currency today by taking a long position in the forward contract. Right? So it's an interlude before we jump into the example. So in this case, if we have no hedged position, then your proceeds for our accounts receivable is going to depend one-on-one on the spot market rate. However, suppose that in this case, Boeing instead entered into a forward contract, right, for payable at the forward rate of $1.32, then the proceeds that they're going to get immediately is this amount. Okay, so what does that do? So for Boeing, the proceeds in terms of the forward position is going to move in this fashion. And that gives you a net position where you can go on the forward contract, and the cash settlement will net you this much for sure to be received if you entered into the forward contract. So Boeing here exported the aircraft, and it's billed, 10 million pounds payable, accounts payable, right? Accounts receivable, because Boeing is getting paid. So in this case, if Boeing chooses to go into a forward hedge, it's going to take a short position today to sell the foreign currency. And for Boeing, because it is a U.S. firm, it's able to lock in to this value if it enters into the forward contract. And the problem for Boeing, if it remains unhedged, that would be if the U.S. dollar strengthens or weakens against the pound. Boeing is trying to receive money. What would be unfavorable for Boeing? If the pound actually strengthens against the U.S. dollar or weakens against U.S. dollar? Good for Boeing if the U.S. dollar weakens against the pound. Right? Because it's receiving 10 million pounds in the future, and if the US dollar actually weakens against the pound, then Boeing is better off because it will receive more US dollars in the future. And by entering into this forward contract, Boeing is trying to hedge against the scenario that the US dollar is going to strengthen against the British pound. Okay, so these are the gains from hedging for Boeing. And if not, so those are the losses from hedging. So those are the potential if Boeing didn't hedge. If Boeing didn't hedge and the dollar actually strengthens against the pound, actually weakens against the pound, then Boeing would not get as much US dollar income relative to not being hedged. So this part is the part that is good for Boeing if it entered into a forward hedge contract, and this part is the part that is bad for Boeing if it entered into a hedge position. However, what we can guarantee here is that Boeing is definitely going to receive this amount in the future, right? So that is part of the problem with hedging. There could be upside potential if the currency moves to your benefit. But if you entered into a hedge, then you locked yourself into a price, and you no longer have the upside potential, right? So that's the potential loss. Whereas what you're doing there, if you are the CFO, you have to always remember and remind yourself, I'm trying to hedge myself against the downward risk. So if you are the CFO and you think that the downward risk is more likely, then you are going to enter the hedge. Otherwise, if the exchange rate actually ends up to be such that you're better off unhedged, then your CEO could probably come and have a talk with you. How come we didn't have that upside, right? So this is a choice that you have to make. And that's why currency forecast and being able to understand which way is the currency likely to go is really important. That helps you to determine whether or not you want to hedge, right? Okay. Option hedge. Analogously, we can conduct a hedge with option contracts. So option contracts are good because they provide a flexible hedge against the downside, but allowing you to preserve the upside potential, right? Because options, unlike forwards and futures, are they an obligation or a choice? They are a choice, right? So you're getting the choice to exercise an option, but you don't have to exercise it if you don't want to. So you have the flexibility. So if we are using options to hedge foreign currency receivables, then we can long puts on the foreign currency. Analogously, we can take a short position in the home currency. If the underlying currency depreciates, the put option allows the firm to sell the currency for the exercise or the strike price. So basically, it sets a floor for the dollar proceeds, but you are able to get the upside potential. And if you are trying to hedge a foreign currency payable, then you're going to long cost on the foreign currency. And if the underlying currency appreciates, the call option allows the firm to buy the currency at the exercise price. So this essentially sets a maximum for the dollar cost, right? Because if you are trying to manage your cost, you want to set a ceiling on the cost. And if you want to get payment, you want to set a floor, so you get upside potential. But of course, nothing comes for free. If you want the flexibility, we have to pay for it. So we have to pay what is called the option premium. No free lunch. So relative to the previous method, we are getting flexibility at a fee, the option premium. Analogously, we can go into money market hedge. So if we are trying to hedge foreign currency receivable with money market hedge, what we want to do is to participate on the money market and borrow and lend. So today, we are going to borrow the present value of the foreign currency receivable. We are going to convert the loan proceeds immediately into domestic currency. And we're going to invest the amount at a domestic interest rate. At maturity, we can then use the receivable to pay off the loan and receive the maturity value of the investment. So again, you're able to lock in a certain value for the accounts receivable. And if you are trying to hedge a foreign currency payable, what you want to do is to buy today the present value of the foreign currency payable, right? Because in the future, you have to pay out cash outflow. So this is a cash outflow, whereas in the previous one, it's a cash inflow. So you're going to invest that amount at the foreign interest rate, and at maturity, the investment will have grown enough to cover the payable that you have to pay. So that's the expense that you have. Cross hedge. So in this case, cross hedge is useful if you have exotic currencies or emerging market currencies where you cannot find instruments at good prices, or you cannot find instruments at all to cover these financial exposures. So in this case, if we're talking about minor currencies such as the Brazilian real, Korean won, and so on, or Polish zloty, then what we want to do is to use cross-hedging. The idea is that we are going to cover the position in one currency by another currency that correlates highly with it. So remember the chart that we saw a few slides ago, right? The correlations between different currencies. So that idea here is that if you cannot find the instrument for the New Zealand dollar, which other currency can you go for? If you are trying to find a contract that trades, right. So if you couldn't find a contract that trades the New Zealand dollars at a good price, or that contract doesn't exist at all, then you can go and look for the Australian dollar contract and try to hedge the risk. Because the idea is, because they co-move together so much, that if you are able to hedge the risk of the Australian dollar, you're going to be able to hedge the risk of the New Zealand dollar, right? So that's the idea. If a US firm chooses to sell a Japanese yen forward contract to hedge its foreign exchange rate exposure of the Korean won denominated accounts receivable, it's the same as in the Australian dollar, New Zealand dollar example. Of course, the effectiveness of cross-hedging depends on how closely related these currencies are. And there's a spelling mistakes here. Okay. And also, we can use currency swaps. Right? So this is particularly useful if you are anticipating a string of receivables in foreign currencies. So time 0, time 1, time 2, time 3, time 4, and so on. You are expecting a string of cash receivables and outflows in terms of the foreign currency. Then what you can do is to set up a currency swap. So how do you do that? You basically enter into an agreement with another company or with the financial intermediary such that you are going to be able to exchange one currency for another at a predetermined exchange rate. So that is called the swap rate. You're going to see this, an analogous example of this with interest rate swaps in your 7041 class. And then you're going to be able to sell and buy the currency at this agreed on swap rate in future dates. So it can be actually seen as a portfolio of forward contracts, right? Because they're precisely the same thing. Swaps are flexible in terms of the amount and maturity. So basically, you can just set it up and negotiate a contract with the counterparty. So they're not standardized, like the futures contract. So what's the difference between futures contract and forward contracts? Commodities are, they're more used for that. And the key difference between futures contract and forward contract are standardization, right? So futures contracts are exchange traded, whereas forward contracts are not. They are on the OTC market. So you can do a lot more tailoring to it, right? So that's the same thing for the swaps. If you have special needs, exotic currencies, then you can enter into currency swaps. So we have talked about the financial hedges. The second method of hedging is natural hedge. So you can do natural hedge by choosing what kind of invoice currency that you want to have, right? That will basically shifts the foreign exchange risk away. If you are choosing to invoice foreign sales in the home currency, then where does the foreign exchange rate exposure go? The buyer or the seller? Who is bearing the foreign exchange rate risk if the invoice, its foreign sales are invoiced in home currency? And home currency, suppose it's the seller's home currency. So who is bearing the foreign exchange rate risk? The buyer, right? So it shifts the exposure from the fund recipient to the fund payer. So that's good. And you can also use invoice currency choosing to share the foreign exchange rate risk. And you can invoice part of your sales in foreign currency and part of your sales in home currency. So now they are sharing probably in some percentage of the foreign exchange rate exposure. Or you can try to diversify your foreign exchange rate risk by invoicing, use a basket of different currencies. An example of that is the SDR that we have talked about before. right? So all of this depends on one thing, your bargaining power with each other. So if you are the seller of something that's only you produce, and lots of people demand that product, then you have more bargaining power to shift the risk away, right? So all of this depends on bargaining power. And also, this depends on what you expect is going to happen with a foreign exchange rate. Yes? Could you repeat this again? I'm not quite sure.
So in Porter's, people usually do firm analysis using Porter's 5 force. So it's like barrier to entry,
Yep.
industrial competition. Then the two specific ones is pricing power over distributor. Like with Amazon, you do have Kohl's doing supermarket, they have a pricing power over the farmers.
Yes.
Then pricing power over the buyers, the customers.
Yes. Okay.
Apple over its customers.
Yep.
It sort of has an advantage to invoice their product
Yes.
in home currency, and then you guys take care of your
Absolutely.
FX risk, and I don't care.
Right. Absolutely. So Jim has pointed out the point that if you are a supplier and you have the you have basically market power in some way, such that for Kohl's, they can price better than farmers. Right? And for Apple, they can price better than some of their competitors. Then if they have that bargaining power, then you are able to shift more of your risks away to your counterparty, right? So yes, that is definitely in line with it. The bargaining power is basically your market power. It's how important you are to your consumers and how important you are to your counterparty in trade. Yep. Very good. And the second part of the sharing risk, that's if you are almost equal, right? We can talk about sharing the profits. Whereas in the first one, one party is definitely have the upper hand side, and they can take all of the profits. The second way to hedge naturally is through lead and lag strategy. If you want to lead, you want to pay or collect early. Right? So what you want to do is to lead or pay early high volatility currency receivables, and you want to collect late. Low volatility currency receivables to avoid the exposure to fluctuations. However, as in the previous case, if you want to do something like that, it really creates a problem for the paying cycle, the cash flow cycle for your trade partners. So you have to deal with these carefully. And that is the same thing in the first case as well. You have to think about whether your trading partner is happy with the whole business, right? I have read in the news that a lot of the companies like Unilever and what's the other company that sells Procter & Gamble, they were having a revolt against Kohl's and Woolworths because they had the pricing power to depress down the price that they buy from these big consumer companies. And then they banded together and they just basically revolted against Kohl's and Woolworths. So that is a precise problem of if you are trying to get all of your profits to yourself, then you have to be careful about relationship management with your trading partners, right? What we want at the end is hopefully a win-win situation. Okay. The third method of natural hedge is exposure netting. So basically the idea is that instead of looking at individual transactions or exposure, we are going to take the entire company as a whole and try to hedge the FX risk as a portfolio of currency positions. So for example, in this case, a US-based multinational company has Korean won receivables and Japanese yen payables with similar sizes and due dates. And because the won and the yen tend to move in similar directions against each other, then the firm can wait until these accounts come due and buy yen with won. So now you try to decrease the kind of fluctuation you are exposed to other currencies, right? Because they're closely related to each other. In this case, even if the hedge is not perfect, it may be too expensive or impractical to hedge against each currency separately. So there is some flavor of the cross hedge here, but it's done through operational netting. Many multinational companies use a re-invoice center, which is purely a financial subsidiary that nets out intra-firm transactions. So first of all, within the firm, they are going to use the foreign exchange exposures to net against each other. They can use the payable from segment 8 to offset the receivables from segment B. Accounts receivable. Right, things like that. You can do that within a company. And once you still find any residual exposure, then you can hedge that. That is going to decrease the amount of hedging that you have to do, and definitely the kind of cost that you have to take on. So this is very good. So what do we do about economic exposure? The same thing as what we would do for transaction exposure management. So everything before that we have talked about was hedging for transaction exposure. So similarly, for economic exposure, we can hedge using financial contracts as well as operational techniques, which are almost exactly the same, right? So you can read through that. The one thing that they talk about specifically in economic exposure that I want to highlight is the flexible sourcing policy. So the idea is that even if your company only has manufacturing facilities in the domestic currency, you can try to source currencies when input costs are low, for example, China, right? And try to lessen the effect of exchange rate changes that way. In this case, if you are a US company and the RMB is pegged mostly to the US dollar, and you do that, you can get a lot of benefits, right? So you can also try to diversify your market by selling products in multiple markets. So you can diversify in terms of economies of scale as well as foreign exchange rate diversification. And then you can do other things such as R&D because then these are more for the future where you can diversify or enhance your product differentiation to make it more unique. So other people are not going to substitute away from your product, and your product is going to have market power. So all of this is about market power and product enhancement. So you're going to be able to increase revenue and decrease cost. contingent exposure. So in this case, what's special about contingent exposure? Precisely. It depends on a third party deciding something, and it could happen or it could not happen, right? So there is uncertainty there. So I already have it. So the best way, because of the uncertainty there, is to hedge contingent exposure with option contracts, right? The option contracts are just made for contingent exposure hedging because of the flexibility involved. Let's go through an example quickly. General Electric, a US-based firm, is bidding on a hydroelectric project in Quebec, Canada. If the bid is accepted, to be announced in 3 months by the Canadian government, GE will receive Canadian dollar 100 million in 6 months to initiate a project. Right? So then we can think about what to do. In this case, we are going to enter into a Canadian dollar put option because this is going to be receivable. So we are going to enter into a Canadian dollar put option where we are going to sell the Canadian dollar that we might receive in 3 months in order to get that in terms of the US dollar. So we have different scenarios. We have the case where we account for an uncertainty of whether the bid is accepted or rejected. And we also account for the uncertainty from exchange rate movements of whether the spot rate is going to prove to be unfavorable for us or favorable for us. So in this case, if we have the case that the bid is accepted and the spot exchange rate is unfavorable from our perspective, from General Electric's perspective, then we are going to exercise the put option. And what about in this case? If the bid was accepted and the spot rate is favorable, so that means it's better to transact on the spot market, are we going to exercise the put option? No. Right? We get a choice to not exercise the option and let the option expire. And in the case of that the bid was rejected, but the spot rate proves to be unfavorable, then what do? We can still exercise the option for pure financial gain, right? Because the option has a better price than the spot market. And so even if the bid was not accepted, we can still exercise the put option for financial gain, right? So that's the beauty of it. And if the bid was rejected and the spot market rate was favorable, then we're going to leave the option expire because we're not going to do anything. Just buy and trading on the financial market is better. So each possible outcome is adequately covered, and with the only catch that you have to pay the option premium upfront. Right? So that's the only catch. So essentially, that has covered all of our discussions on foreign exchange rate management. So we have talked about how to measure the different kind of exposures, and we have talked about how to use financial hedge as well as natural hedge to try to manage and reduce the risks. Option, they are great. They provide a flexibility, but we have to account for the upfront premium cost, right? And then we have to think about whether that is going to be cost effective. At the end of the day, we're thinking about cost effectiveness and whether or not we are able to forecast the currency as accurately as possible. Okay. All right, so that leads quite well into the next part, which is the slides on the next part. Okay. So from where we left off, we talked about the choice of a hedging method depends on the cost, right? The cost and benefit. So this example here is exactly an example of how we go through the cost and benefit analysis of choosing between different types of hedge. And these are focused on the financial hedges. So here we have DSQ as a US-based multinational company that will receive 200,000 Swiss franc in 6 months. You're given the information below, and what you need to do is to compare the different hedging strategies using financial contracts and decide on the best strategy for DSQ. So the best strategy, let me reiterate again, it's going to be the most cost-effective one. That means adjusting for the cost, you're going to have the highest amount of benefit. All right, let's go ahead. So this is the probability distribution that tells you what DSQ thinks to be the probability that the exchange rates will be on different scenarios. Okay, and it's an accounts receivable. Forward hedge. With forward hedge, what do we do? Enter into a forward contract at the rate given, right? So we're going to lock in a cash flow in 6 months that we're going to receive in 6 months' time today. And what we do is to multiply the amount of receivables that we're going to have by the forward rate. So that is the amount that we're going to have. Remember this number. The second method that we talked about is the money market hedge. So in this case, money market hedge, we're going to borrow and lend on the money market with loans and deposits. So what we're going to do today is to borrow the present value of foreign currency receivable, right? We're going to borrow it so that we can cover it in 6 months with the CHF receivable. So that's how we determine whether we want to borrow or to loan. So this is the amount of Swiss franc that we're going to borrow today. We're going to convert the loan proceeds at the spot rate into the domestic currency. The spot rate is that. And we're going to invest that amount at the domestic interest rate on the US dollar, which is 2%. And at maturity, we're going to use the receivable that we talked about here to repay the loan. And netting everything together from this position, right, then the DSQ is going to receive the maturity amount of the US dollar investment. So, relative to the one before, they are going to receive this much money. So already, compared with the forward hedge, which one is the more cost-effective hedge? Or the one that gives you better outcome? The forward hedge, right? Because at the end of it, you're going to receive more US dollars. All right, so remember that for now. Third method, option hedge. We're going to buy a put option in the Swiss franc. So recall that we have that much Swiss franc receivable. So we go through this exercise, and we have to calculate the expected return in this case, right? Because we have to figure out the probability of exercising the option. Okay, so we have the 3 scenarios, and we have the 3 potential spot rates. So that came from the question. So this was given in the question. And the option premium for the put option is 2 cents per unit. All right, so we have to take that into consideration. Okay, so in the first case, if you are trying to receive Swiss franc, the strike price on the option is 72 cents. If the spot rate is 71 cents per Swiss franc, are you going to exercise the option or not? Yes or no? Yes, you're going to exercise the option, right? Because if you don't exercise the option and you convert the Swiss franc into US dollar, you're only going to get 71 cents per Swiss franc. But if you exercise the put option, you're going to be able to do 0.01 cents better, right? Because you want to get more US dollar, right? Always remember this. You're getting foreign currency receivable. The favorable option for you is that you get more in domestic currency, which is the US dollar here. So you're always going to think about which option gives me more in terms of the domestic currency. So in this case, if the exercise price is 72 cents and it's higher than the spot rate, you're going to exercise the option. And what about the next case? The spot market gives you 74 cents US dollars per Swiss franc, whereas the strike price gives you only 72 cents. Are you going to exercise or no? No. It's better off that you exchange it at the spot market, right? And analogously, the same thing for the last example. You're going to get more in US dollars if you actually just do the exchange on the spot market. Okay, so we're done here, essentially. So the amount you are going to receive in the first option is 72 cents, 74 cents, and 76 cents. And then what about the cost, right? We have to always remember the cost in the option hedge. So if we take into account the cost minus the cost, net out cost, then essentially we're effectively receiving 70 cents on the amount, 72 cents and 74 cents. Because even though you did not exercise the option in the last two scenarios, you still bought the contract, right? So you have to account for the cost as well. So the net amount that you're going to receive from hedging are going to be these values accordingly. Okay? As a sidetrack, if you looked at this and you looked at the market rate, would you think that you're better off if you didn't hedge? You're right. So that's the probability, right? The first scenario is about 30%, and the last two scenarios are 70%. So in this case, it goes into telling you whether or not it may be better off, you may be better off if you actually didn't hedge in this case, because you actually anticipate that the spot exchange rate is going to be in your favor, and that's 70% likelihood. If that is a big enough probability for you, you probably is not going to choose to hedge, right? Hedging always comes at a cost. So taking the column 8, the amount that we're going to receive in each scenario into consideration and multiplying each of those with the probability of each of the scenario, we're going to get this as the expected value of the cash that we're going to receive using the put option hedge. So putting all three strategies together, the best strategy here is going to be which one? The option hedge, right? So it's going to be the put option hedge. And here, remember what I said. If you actually believed this probability distribution, I could equally ask you, what if you didn't hedge? Compare all of the hedges with the option that you didn't hedge and see what the outcome is. I'm going to leave that to you as an exercise at home. Believing that this is the right probability distribution for the different scenarios. And calculate whether or not you might be better off if you actually didn't hedge. Right? Okay. Because even though we're talking about the significance of hedging, there are still quite a few companies out there that are not choosing to hedge. Under different times, maybe not always, but that is probably determined by whether they think the exchange rate is going to move in their favor or against their favor, right? So take a look at that. So that leads to my other question, right? The question that you're going to do at home leads to this. Should a firm hedge or not? There are pros and cons. There are ideas that it is bad to hedge because you know that hedging comes with costs. If you don't go into option hedging, you are taking off the upside potential, right? And everybody likes to have the upside potential. Once you hedged, you forget that you're trying to hedge about the downside potential. That's often the case, right? It's difficult to think about what you were trying to hedge against, but it's easy to see that you probably lost some money by hedging. So there is a dilemma as to whether or not you should hedge. If you are in a perfect capital market, there are multiple arguments against hedging. First of all, it is argued that investors who invest in your company, they do not need the company to hedge because they can do it themselves. It could be that if you have a company, and I know very well what you do in your operations, I specifically buy your stock because I like that kind of exposure, right? So if you hedged, then it is bad for me as an investor because you just took away the exposure that I wanted, right? So it's just like investing into foreign stocks. You're trying to get exposure away from your domestic investment. So if it's in a perfect capital market where both investors and managers know every bit of information, so there's no information asymmetry, then the argument is that if you hedged, that it's going to take away the exposure that I wanted, right? So that's the argument for homemade hedge. Insulation. I want that exposure. If I don't want that exposure, I'm going to invest in some other company. Or I can choose a portfolio of different companies where all of the potential risks are netted out. So it is my choice as an investor to do that, not what you should do. You should just focus on your core business, right? Just producing the product and sell it. Don't waste time and effort on hedging. So that's the idea in a perfect capital market. Currency diversification. So the idea is that if you're a multinational company and you hedged, then that takes away the benefits from a portfolio of different currencies that can diversify away of your risks, which we saw in the example of the value at risk with the portfolio of currencies. Right? So what I said is important, right? If you are seeing this in an exam, and if you just write this, and this is worth of 3 marks, and you didn't write the intuition, then that's only going to give you 1 out of 3 marks. Intuition is always important. Yes? Usually these companies hedging, actual hedging strategy, if you Googled it, it's very difficult to find, right? So that only happens in a perfect capital market, right? Right. So and also the idea of the first point is because hedging itself takes time and effort. And if you actually do that, then it's going to take away your effort and time in your core business, which is about selling the product, making the product better, right? So it's not costless. That's why you have these arguments against it, right? So even though you can try to find information about the firm's actual hedging strategy, it's very difficult. And plus, it's not costless. So that's the problem, right? Okay. The second part is currency diversification, which we talked about, where a firm can potentially have a more stabilized cash flow if there is a portfolio of different currencies. So the exposure to these different types of currencies is going to offset each other. All right? So that's that. The third part is agency cost. Management often conducts hedging activities that benefits itself at the expense of the stockholders. What does that mean? Again, it's related to the first part because hedging itself is costly in terms of money and effort. But why would managers still want to do it? Well, first of all, managers could be more risk averse. Than the typical stock investor. Because, why? Their compensation, exactly, very, very good. Compensation and job security linked directly to their cash performance, financial performance. Yikes. So linked directly to their financial performance. So what they don't want is volatility in the cash flow, right? So they don't want suddenly the cash flow to be much higher, which might be good, but it's equally likely that the cash flow is very low because of foreign exchange rate fluctuations. So what they don't want is fluctuations. And they want a stable cash flow stream. And this thing is that they would think also, as a result of this, managers would think that they would be criticized more if money is lost. Oh, actually, let's not use that. If money lost in FX fluctuations, then spending money on hedging. Right? So all of these arguments are based on that hedging is costly. Hedging is costly. So perhaps if we have perfect information, perfect capital markets, these are the arguments against it. And again, please note that it's important to explain the intuition if you are asked questions like this. What about in favor of hedging? Again, the assumption is very important. So we talked about the assumption of perfect capital market before. Now what about in an imperfect capital market? Obviously, you would not expect in the current world, as we talked about, the investor will have more information or equal information than the manager, right? So there's information asymmetry. Stockholders do not have better information than managers and firms. And managers could be very reluctant to tell the investors their precise hedging strategy. First of all, why do you think that they are reluctant to tell of their precise hedging strategy? Forgetting about everything else. Pardon? Competitive advantage, right? It is very costly to come up with a really good hedging strategy. If you make it public, then your competitors can free ride on you. So, right? So your competitors do not have to invest the time and effort in coming up with that strategy. So in effect, you are at a worse position if you actually made it public, right? So there are various situations that can lead to information asymmetry. Also, in favor of hedging strategy by the firm, it's firms, by virtue of having larger transaction amounts, they are able to have lower transaction costs. They have better access to different products, and they have better spreads on the products. Right? So this is what we talk about. So this is better than retail individual investors. They also, over time, they accumulate expertise, and they are able to overcome different challenges in terms of FX diversification. So it's actually sort of building on the information asymmetry part, as well as the lower transaction cost part. And firms would be able to hedge better and at a lower cost than the individual investor. Also, cash flow stabilization, which we talked about. So this is important in terms of the firm to manage investment activities. Because if you have a stable cash flow, you're able to forecast what you want to do in the future better, right? You know at 3 years' time, well, that's a little too far. At 3 months' time, you will have a certain amount of cash flow, and you can use that to make an investment. Whereas if you don't have a stable cash flow, you want to make an investment in 3 months' time, but suddenly you don't have as much money because of foreign exchange rate risk. Then that is going to affect your investment strategies. So in this case, cash flow stabilization is actually good for the company, not just for the manager, right? And then in this case, this should go later, but it's fine. So it's also going to help with progressive corporate taxes if you have a smooth cash flow, because the idea is that if you have ups and downs in the cash flow over time, you might end up with higher taxes than if you have a stable cash flow, right? So in this case, ups and downs might lead to higher tax cost than if you have a more smooth cash flow. And because of both of these, it's going to improve your ability to meet costs, to meet payments, and reduce your probability of default, right? Because again, like what I said, if in 3 months' time you have an interest payment of $3 million due, and you were hoping to pay that interest payment with an accounts receivable from foreign sources, you expected $3 million as well. But if you didn't hedge and the exchange rate was bad for you and you only have $2 million, then you just do not have enough money to cover your interest payment. And what is default? Default is if you are not able to meet all of your financial obligations. So you could be forced into default or restructuring and everything. So that comes at a really big cost, right? So in this case, if you actually hedge, it might give you a smoother and more forecastable cash flow. And so that's going to be better for you in terms of managing your expenses, investments, and reduce your potential to go into default. Any questions? Yes?
I just wanted to understand, how does hedging work when a certain currency is pegged to, a major currency? Say, for example, the Chinese yen is much more regulated and, if I'm not wrong, is pegged to the US dollar?
Somewhat. It's pegged, well, it's related to a basket of currencies at the moment.
Yeah. So how does hedging work in countries like this? I mean, because it's already pegged to a certain unit of currency, the fluctuations are already managed there?
Yes. So the question is, if you're operating in a currency that is pegged to your home currency, how do you go about hedging? One of the suggestions is no hedge. What do you think?
I think the same thing.
Exactly. So if you actually have exposure to currencies that are highly correlated with your own currency, right, almost moving one-to-one in the cases of pegs, then you don't even have to hedge and incur the cost, right, because it's almost acting as if the value of your own currency. Yes? Yep.
So when the currency of the country is pegged to yours, you're only subject to political risk. And then, so you will purchase insurance that only covers legal risk of the ruling party change leadership and all these things. So you pay a very thin premium because the likelihood is usually not very high. So that's how you hedge.
Yes. So Jim offered a really good example here of how you might want to do it in practice. Because, again, a peg could devaluate or be revaluated, right? A currency could do that. So it usually happens if there is a change of power, change of political parties that's heading the country. So what you might want to do in reality is, what is that insurance? Yeah, what's the name of the insurance? It's just one of them, right? Because there are others. Yeah. Yeah. Yes. Right. So basically, then the product that you can actually get at, Jim suggested the name is PRI, but there are other insurance products like that that's offered by insurance companies where it breaks down the currency risk into political risk, what other risk? Commercial and legal risk for your exposure to other companies. And so you can just buy the exposure to the political risk, so the risk that the currency is going to devalue or revalued because of a change in power. And you can get that for a cheaper price than getting the entire package. And then you can hedge the risk that way. And it's cheaper than going into a foreign exchange market to do it. However, I will argue that if you actually do find a contract in a foreign exchange market, they're going to account for that as well. Yes. Yes. Yeah. Yeah. So in this case, it's so Jim offered a discussion includes other considerations as well, but in this specific example that you are asking, which only talks about pegged currencies, then the only real risk or tangible risk that we can see is the political risk, right? Yeah. Great discussion. All right, so that pretty much ends 3 parts of our course, right? We have talked about 3 parts. First part, international framework, that we introduced ourselves to the major market instruments. The second part is how do we determine prices in the foreign exchange market, and that is the exchange rate determination. We had topics 2 to 5 on those, and then we just finished how to identify and manage foreign exchange rate risk, and that was topic 6. And tonight or tomorrow night, you're going to see a problem set related to topic 6. You already have problem sets for the previous topics, right? And now we go into the final part to this course, and they're highly related. Remember, in the first class we talked about why firms want to go global, right? It is to either reduce cost and also to increase their opportunities. So here, in the first 2 topics, we're going to talk about the topics 7 and 8. We're going to talk about how firms can try to decrease their costs, mainly, by going into the international capital market, by especially in the making bank loans and money markets. And then in topic 9, we're going to talk about how they can decrease their cost of capital by going on the international debt and equity markets. And then in topic 10, we can talk about diversifications to international investment in order to increase our expected return, risk-adjusted return. So these 4 topics are related very much with each other and tells us what kind of expanded opportunity sets that we have by engaging in the international marketplace, right? So this relates back to what we talked about in topic 0, the first class. And we're going to spend some time going over the framework in topic 7, which is quite short, to set you onto the framework on what we think about in terms of topics 8 and 9, and somewhat for 10, and let's do that. Okay? So for a firm, when we're talking about a firm's cost from your corporate finance class, right away we talk about the cost of capital, right? And the cost of capital that we are concerned about for a public firm is the weighted cost of capital, which is a weighted average of a firm's cost of equity and the firm's cost of debt, right? This is very familiar, I should think. Very good, very good. So this is not new material, right? So we are having the weighted average cost of capital here. So what do we need to do? We can look at each of these costs by themselves in order to decrease the costs by going international or going global. Cost of debt is essentially the interest that you're going to incur on debt, which are loans from commercial banks and bonds, right? So that's what we're going to go over in topics 8 and 9, where we introduce a range of international debt instruments and also bank loan instruments. And cost of equity is the risk-adjusted expected return on the firm's capital that investors require. So that is what we're going to talk about in topic 9. This return of cost of equity is often estimated using the CAPM model, right? So this is what you're going to be using. The cost of equity for firm I is a function of the expected return of the risk-free asset and the and beta and exposure to the excess return from the market. So that's what we're going to have for estimating the cost of equity. Again, this should be a review of your corporate finance class. Very good. What if we went global? If we went global, then the cost of debt might change if you are able to find funds for cheaper internationally. And you might be able to find equity to be cheaper as well if they require less return on the equity because they have diversification. So if we're able to go onto the international capital market, this is going to change for the cost of equity. Instead of what we had before, our market portfolio is going to be the world market portfolio. Instead of just the Australian stock market, we are able to hold the international stocks in our portfolio. So what does that do? That gives us greater diversification, right? It gives us greater diversification. It reduces our expected return from the stock market. And so that's going to potentially reduce the cost of equity from these markets. And that is the case if capital markets are integrated. That means investors are free to invest in any of the capital markets. In this case, stocks with similar expected returns and risks should have the same required return in each national market, adjusting for exchange rate risk as well as political risk. And then we can use the international CAPM to calculate the expected return. What if we don't have perfectly integrated markets? Then we have a case where we have capital market segmentation. Capital market segmentation is the restriction on fund flows between different national markets because of various imperfections. And these could come from government constraints, different institutional practices, and different investor perceptions. What do I mean by those? Government constraints. What are we having right now in our news headline? The trade war, right? So we have barriers to flows of funds and capital. So I use funds and capital interchangeably. And we also have different institutional practices because in perfect capital markets or perfectly integrated financial markets, we will have symmetric information. And that means transparency and so on, which we cannot assume for every single market, right? So we also might have very high securities cost. So that goes into the transaction cost. So, sorry for my writing. It's very difficult to write like this. Transaction cost. And then you have other things such as FX risk and so on. FX risk, and political risk that all have to be factored in. That changes the institutional environment for the capital markets. And you also have investor perceptions. That means if you are an Australian investor, you know more about the Australian stock market, or you may be feeling more patriotic in supporting an Australian company. So even though by investing outside of Australia might give you higher return, you still refuse to do it, right? So that's what we call home bias, that you have an inclination to invest in home stocks or even local stocks. You are more likely to invest in a Canberran company rather than a Perth company, something like that, right? So there is a local bias in terms of investor perceptions. Home bias, patriotism, and so on. So all of these things causes the capital market to be segmented. What does that mean? Then investors are restricted to only invest domestically or within their own region. And that also means that securities have different costs. Right? So that's the bottom line as to why we care about international markets. Because with capital market imperfections, such as market segmentation, we have securities that are priced differently in the domestic market versus different national markets. So what the firm wants to do is to go out there and get and exploit these different costs and prices. Okay? All right. So here, what we are going to have is fairly different. If we have an integrated market versus a segmented market, then basically the kind of exposure that we have is going to be different. The major difference here is this, your market portfolio. Again, as I said before, if you have a market portfolio that includes the entire world, you have much more diversification going on, and your required return is going to be lower. Whereas if you're only restricted to your home equity portfolio, then you have higher systematic risk, and so your required return on just that home portfolio is going to be higher, right? So this comes from diversification, and this tells you differential costs. Of equity. So far so good. Do we see that actually? So this is a graph that tells you that diversification might be good. So this is an aggregate study, right? So on the bottom line, the x-axis, it's a measure of home bias. And as I said before, home bias is so tiny down there. But I'm going to talk more about this in topic 9 and 10. So home bias, again, is the local investor holds a disproportionately large amount of local assets relative to foreign assets. So there's not enough diversification going on. The higher this index, the more local investors like to hold their local assets. So what do we see here? If you are investing in an area where there is a high amount of home bias or more holding of home asset, then your cost of capital increases, right? So this is aggregate evidence that cost of capital does go down if you are able to diversify more. So that brings us to our other topics and of going global. There are two main sources of funds for companies, either internally or externally. Don't worry about the writing because you have the next slide on this, but I just like to see it on a graph. Internal cash funding comes from your retained earnings and so on, so that's good. But what if you don't have enough money to run the business? Suppose you have 20 million from retained earnings. You have a project that costs 40 million. So what are your options? Your options are to go out there and borrow from the bank, or to issue bonds on the public market, or what's the third one? Equity, right? You're going to reissue IPOs or secondary equity offerings and so on and raise equity, right? So you can cover this shortfall by raising capital. Sorry, it's going to go over here. Sorry about that. What? Okay, you know where the lines are. Okay. By raising, oh my God, capital, or what we call funds from loans, bonds, and equity. And the rest of what we are going to talk about focus on the three ways, okay? So all you need to remember for topic 7, 8, 9 is this graph. We're going to be focused on how to reduce the firm's costs by looking at how the firm can use different instruments on the international market in order to raise capital from either loans, bonds, and equity. Okay, that's it. And our ultimate goal is to reduce the cost of capital, right? That's all you have to remember for 7, 8, and 9. That's the fundamental idea. And then the rest of it is just filling in the details of what can you use, what's available there, right? So the key idea is here. So this summarizes, as I said, everything that I have written there. And the main idea in the bottom that you should probably distinguish is primary market versus the secondary market, right? Do you know the difference between the primary market versus the secondary market? Yes, I see nods. Basically, you issue the securities in the primary market, and the securities can be resold in the secondary market. Very, very good. And so, good. You all know that. We don't have to cover it. Okay, so sources of funds, if we're looking at the different markets and different ways, comes from the money market or the capital market. So the money market and the capital market only differs in maturities, because there are all financial markets where you can trade debt instruments or securities. In the money market, it's for maturities of less than 1 year, whereas in the capital market, it's for maturities of more than 1 year. So that's just financial terms. I didn't come up with these. These are just financial terms that you should be familiar with. And the instruments that you're going to use very often in the money market are all of these ones, whereas the instruments that you're going to see in the capital market include the corporate bonds and equity. right, which we're going to refer to as debt financing and equity financing. So if you want to go into investment banking, you are trying to work in this area, right? You're in the either debt capital market or the equity capital market. And also, on the capital markets, you see mortgages traded, treasury bonds traded, and other government bonds traded at the municipal, state, and federal level. Okay. I'm just making sure she's okay. But we're not going to talk about those because those are not for the corporation. Our focus is purely on the corporation. So, to recap everything that I said, this is mainly on the big picture that we are aiming to reduce cost and increase expected return. And that's why we go on the international market when we need to raise funds externally. And when we raise funds externally, our aim is to reduce these two kind of costs. And there are the three sources that we have to look for, and that's it. Let's take a 3-minute break. Huh? Yeah, I know. So let's just take a 2-minute break. We will restart again at 35. Hi.
Last topic?
Yes.
How long adoption will lie? Is it
Is it working? Yes, it's working. All right, good. At least I sound better. All right, let's go. So we talked about the relationship between the capital market, the money market, and why we're going on to those. So this topic, we're going to focus entirely on bank loans, right? And why the money market? That's because in the international banking arena, bank loans on the money market is the instrument that they use, right? So this is how it goes. It's the first way that you can raise external capital, by going to an international bank and try to get loans. All right, so the big picture that we have planned for this topic are the following four ideas. So we're going to go through what is international banking, introducing you to some of the current trends in international banks by market capitalization, the different types of international banks, and the kind of instruments and marketplace for international banks. So even though we refer to the international money market, basically international banks operate heavily in the euro currency market, right? So that's what they're going to do. And we're going to probably leave the last topic of the implications of an international banking network to the last class. Let's see how we do. Okay, so back to this graph again, right? Remember, we're talking about, just before the break, we're talking about the top is the internal source, and the bottom is the external source. And in this topic, we're just going to refer specifically on loans made by banks to corporations. What is international banking? I was looking around on the website on how international banks describe themselves. So I thought that HSBC had this line there to describe themselves, to sell themselves as an international bank, as the bank without international boundaries. So you can get mortgages or loans abroad easier by going with HSBC and so on. So that's the idea of international banks. You are able to have just a one-stop shop for your banking needs or your financing needs. So that's what they offer to you. And this is a description by National Australia Bank, right, for their marketing spiel in China. So they talk about really on providing extensive ranges of banking, risk, insurance, and investment services to all of its customers. And they recognize that, they are going to be able to provide quality products and services, fair fees and charges, and relationships built in the principle of help. So that's the idea of expanding from local markets into international operations. But of course, this is not an advertisement for either NAB or HSBC. I personally do not like HSBC because I think that they have very poor customer service in either Canada or here. I had very poor, pardon? In India too. Okay, we have feedback from here. I listened to this macro investment podcast, and they were talking about HSBC investment in Hong Kong and how, that the customer service is so bad that if you invest 1 million Hong Kong dollar into the bank, you get to be HSBC Premier. But the only thing that you get is to be treated slightly worse than the kind of treatment that you get from all other banks in the world. And the perk is you get to sit instead of having to stand. And that's for 1 million Hong Kong dollar. I usually don't talk about other companies or products, but I was very bitter about my treatment from HSBC. Obviously, I do not have 1 million Hong Kong dollars. But anyways, So, but that doesn't change the fact that HSBC is a very big and global bank. I was trying to actually Google, why is HSBC so popular or so strong, even though it treats its customers so bad? But it's an outstanding question. Okay, that aside, international banks are basically offering the same services that your domestic banks would offer, plus that they're able to do everything internationally. So if you have dealings with an international bank, if you go abroad, you can probably go to the branch of that bank that you have locally and arrange for trade financing and raising funds in a simpler way. But that doesn't often work in this case because there are lots of issues. Right? I moved from Canada to Australia. I tried to find HSBC because I thought that it had a presence in Australia and hoped that it would be able to easier transfer my money from Canada to Australia. That was a terrible experience. But anyways. Okay, so yeah, I am not that bitter. It's probably because I'm so tired. So where are the top banks located in the world? So from this map, you're probably going to see that, so these are the numbers, right? The numbers of big banks by market capitalization, and the size of the circles determine how large they are by market capitalization, right? So where are the big banks, big international banks located? China. By far, so they have 18 big banks that rank in the top 100. Elsewhere?
I'm surprised India has actually got one. We never knew of it.
Okay. Can you guess which one is that? ICICI, yes, I think, yeah. So India also has presence. Europe, actually, if you put Europe together, they will have more big banks, but because Europe is segregated into smaller countries, so they don't appear as big. So at the bottom right-hand side, that's the blow-up of Europe. And then the next one is obviously the US, right? They have 11 of the biggest banks, and probably you can name most of them, right? So Barclays, Bank of America, Citigroup, JP Morgan. Yes? Yes. Yes. Okay. So that is a different story because we don't have that ranking yet. Yeah. Yes.
Italy is heavily exposed, so UniCredit in Italy probably is.
Yes. I agree with you there. Yes. So Jim was raising the point that because of the banking crisis that we just saw in the past decade, nowadays banks are ranked on their risk-adjusted or risk-weighted capital instead of just looking at their aggregate capital or market capitalization. So if you actually factor in their risk-adjusted asset, which takes care or controls for the amount of toxic asset or non-performing loans on their balance sheet, then this might look quite different, especially for, say, some of the European banks, right? Italian banks, Spanish banks, and so on. But so far, we don't have that ranking yet. So we'll go with this one first. But that is a very good concern. Yes. And it's also related to the extension of this topic that I'm going to talk about next class, right? So about how healthy is your balance sheet. Very good. So if you care to look at some of the top banks, then you can look here. There is a list of the top banks, which, what? How do I? Right, so this gives you a list of the 15 largest banks in the world by total assets, starting from the bottom. So Deutsche Bank is ranked 15. Walter, can you share why you're laughing? Sorry. Okay, so it's about all of the. Yeah, so Walter was laughing because Deutsche Bank has basically one of the largest exposures to all of the problematic European banks. So that's why he was laughing, because the risk-adjusted capital of Deutsche Bank is probably pretty low. All right, very good. I like that interlude. 14, Sumitomo Mitsui Financial Group in Japan. 13, Citigroup. 12, Japan Post Bank. 11, Wells Fargo. 10, Crédit Agricole, which is a French bank, also with very heavy exposure. 9, Bank of America. 8, BNP Paribas, again a French bank. 7, our beloved HSBC. 6, JP Morgan Chase from the US. And 5, Mitsubishi UFJ Financial Group. 4, Bank of China. 3, Agricultural Bank of China. 2, China Construction Bank. And 1, Industrial and Commercial Bank of China. So the top 4 of the largest bank in the world by market capitalization are Chinese banks. But I also want to emphasize that they are starting to develop further and further into what we're going to talk about in terms of international financing. Right now, the really big and established players in the money markets, debt markets, and equity markets are still the US banks, right? Yes?
Small question. Do you mind if I ask, how do Chinese banks actually function, just out of curiosity?
Oh, the question is, how do Chinese banks function? I would love to answer that question privately in the time. Yeah, right? Because I want to finish covering something, but you're most welcome for any of you who are interested to come to my consultation and talk about that, because that's not part of our course coverage. And you're going to know more in Asian capital markets.
That's an elective.
Right. So I'm taking a plug for the other course. Okay. All right. So what are different types of international banks? They came in these main types. So they could be correspondent banks, representative offices, foreign branches, subsidiary and affiliate banks, offshore banking centers, shell branches, and international banking facilities. So we're going to go over the definition and examples of each of those. And then we're going to think about why might banks choose these different types, because they can choose from among these different types any or all. But let's see, go through the definitions. The first one is a correspondent bank. A correspondent banking relationship exists when two banks maintain deposits with each other. That's it. Correspondent banking allows a bank's multinational corporation clients to conduct businesses worldwide through his local bank or its correspondents. So it's a very easy relationship, right? So it's like I am a bank A and you are Bank B operating in India, for example, and then we have a corresponding relationship, and then my clients can go to India and ask you for help. So if you are able to have a nice relationship with a bank in a foreign country, that's a pretty easy and nice way to do it. They sing very well out there. So a lot of corresponding banking relationships exist between North America and Asia, and as well for North America and Europe. And as you can see, that I discovered in practice, there's very little relationship between North America and Australia. So that's what made it really difficult. But that's also an HSBC problem, because they have branches here. Sorry. Anyways, a representative office is the other type. Is a small service facility staffed by parent bank personnel that is designed to assist MNC clients of the parent bank in dealings with the bank's correspondents. Okay, so representative offices can also assist with information about local business customs and credit evaluation of the multinational corporations' local customers. There's also an additional feature of representative offices is to do research about the local government, about the local economy. Right, so they gather information and intelligence about a local economy and then feeds that back to their parent bank for their competitive advantage. So this is a list of the 14 foreign banks with consent to maintain a representative office in Australia. So we have, that's the latest list. So we have banks from Spain, banks from Germany, banks from China, banks from Sweden, banks from Greece, and banks from Korea, and banks from the US. The interesting point here is the People's Bank of China. For those of you in the know, is People's Bank of China a commercial bank? No, it's the central bank, right? So it is quite common for central banks to maintain offices to maintain representative offices in other countries. Most of the central banks have presence like that. The Reserve Bank of Australia also have representative offices in Beijing. And their purpose is not to help corporations or commercial clients to gather information. Their purpose is to help the country as a whole to gain knowledge about the local economy in the location of the representative office. So it's very common for central banks, even though they don't have any commercial relationships, to maintain representative offices. Okay, so, so NAB, which is a commercial bank, also has representative offices in China that has been established in 1982, and that was in Beijing. And you can also find additional information as well. The other type is foreign branches. A foreign branch bank operates like a local bank, but it's legally part of the parent, and is subject to both the banking regulations of the home country and the foreign country. So this is a step up in terms of regulatory requirements from the representative offices. It's more, in a way, costly. And as a result, it can provide a much fuller range of services than a representative office. Branch banks are the most popular way for US banks to expand overseas. So this is a list of the branch banks that operate in Australia, and this is a list obtained from APRA, which is the Australian Prudential Regulatory Authority. And this list actually goes on. If you want to know the full list, you can go on to APRA's website. Yes? Okay, so the question is about loans made by different offices. Let's keep this question until the summary page that we're going to have. Just wait for a few more slides. Yeah. All right, so that's for foreign branches. We also have what's called subsidiary and affiliate banks. So if we have a subsidiary bank, we actually have a locally incorporated bank entity. So that is wholly or partially owned by the foreign parent, right? So we are seeing that there are different institutional characteristics here. An affiliate bank is one that is partly owned but not controlled by the parent. So again, there is the difference in terms of the control rights and the kind of also taxation and reporting implications. US parent banks like foreign subsidiaries because they allow US banks to underwrite securities. So now this is the additional advantage of having a subsidiary bank over other types of forms of international banking because of the extra ability to do business. And this is a list of foreign subsidiary banks in Australia. Looking at this list, does anything strike out to you as slightly interesting? No, not HSBC. Bank of China, why is it interesting? What kind of securities would they underwrite? They can do that for the Chinese companies if they wish to raise capital in Australia. They could, if the Chinese company wished to, yes, to get equity or debt financing in the Australian capital market. Does Bank of China also raise sovereign bonds for the Chinese government? Yes. Yes, they do. Okay, so any other ones on the list that occurs as a bit weird to you? Bank of Sydney, yes. Bank of Sydney, by its name, sounds like an Australian bank. But it's a... No, it's not a Canadian bank, but it's definitely a foreign bank. And it's owned by the Bank of Beirut, which is a Lebanese bank, the largest bank in Lebanon. Okay? So, prior to 2013, Bank of Sydney used to be called the Beirut Hellenic Bank. But as of 2013, they decided to change their name to the Bank of Sydney. Why do you think that is the case? Yes. So it sounds more like a local brand, right? So this is what banks are doing in order to attract customers and attract business, right? So that's why even though Bank of Sydney sounds very local, it's actually a foreign bank, foreign subsidiary. Okay, very, very good. The other type is offshore banking centers. So we have offshore banking center, which is a country whose banking system is organized to permit external accounts beyond the normal scope of local economic activity. So usually, these are really great in terms of regulatory requirements because the host country usually gives complete freedom from the host country government banking regulations. So these are sources of friction that can increase the cost of financing, right? So the IMF, International Monetary Fund, recognizes the Bahamas, Bahrain, Cayman Islands, Hong Kong, Netherlands, Antilles, Panama, and Singapore as the main offshore banking centers. And then we also have shell branches, which are you don't have to have more than a post office box, and the actual business is done by the parent bank at the parent country. So these are all definitions, and then finally we have what's the international banking facilities, which is which maintains a separate set of accounts that are segregated on the parent's book. So any U.S. bank can have one, and they are the ones that capture a lot of the Eurodollar business that was previously handled offshore. So this summarizes basically the overall characteristics that distinguishes between one type of foreign bank existence to another, right? So if we are looking at Jim's question about loans made from representative offices versus that from a foreign branch, well, basically, if you are operating in the U.S., if you are operating a representative office, you cannot make loans, right? So your choices in which form of international exposure the bank wishes to take on depends on what kind of business they wish to do and whether they are wishing to expose themselves to regulations, right? So it depends on business goals and regulations. Okay, so that's where I'm going to finish. And next class, we're going to talk a bit more about what kind of decision-making goes into an international bank choosing between these different forms. And please don't worry, I extended the capture, so it's all captured and recorded. Thank you for your patience.